And I do think that importantly, I don't know when the selling is going to end. I wish I did.
Yeah.
But I do think the way I approach it, at least, is to say, okay, you know, what are the factors creating unease and desire to sell, and then what are the offsets to that? And I do think it's important to note that there are, I think, some pretty significant offsets. One of which is seasonality. October is known as the bear killer month. And people who do analogs, seasonal analogs, technicians, you know, tend to say that we're probably pretty close to the nadir, the bottom of this current period of weakness. So seasonality is better. That's important. Delta is fading. That's probably the most important. Clearly, not just here in the U.S. or in Europe or in South America, but really pretty much globally, it's fading, and there's no other major variant coming behind it. That is leading to what I've been talking about over the last couple of weeks, the Asian reopening, which continues to unfold. Japan has lifted its lockdowns. You have a situation where global airline departures are at their highest since the pandemic really took root in the spring of 2020. So the Asian reopening trade is underway. Tactically speaking, I think we're probably closer to the end than to the beginning of this sell-off. But I have to also say that I've been surprised by the persistence and kind of the aggressiveness of the selling. And we saw that again today, where without any kind of move in the rate markets or anything, technology got absolutely hammered with a lot of things down, 3% or more. Well, I think it's a great question and a key question, and I'd recommend to folks who have access to it. JP Morgan put out some good work over the weekend talking about exactly this issue and raising the question whether it was supply related or demand related, and whether it's going to lead to stagflation or more inflation pressures. And they kind of came down on it's a mix of both supply and demand issues. Obviously, as you point out, the UK. One could argue that the real issue in the UK is a shortage of drivers to drive the fuel trucks around to where it's needed, which is directly tied to Brexit, as opposed to anything beyond that. But that's not quite the full story. As we know, when you look at the Dutch gas market, which is the main kind of European-wide gas pricing model, it's, gas prices, natural gas we're talking about, not gasoline, is up, well over 100%. And so part of that is destocking over the course of last winter, failure to build inventory because people weren't sure how strong the economy was going to come back. Economy coming back in Europe, particularly in the last, 3 to 4 months, stronger than expected. Issues around Russia providing gas to top up supplies because they wanted to start the Nord Stream 2 pipeline. There's a whole host of issues. China, there was a big headline that came out of China, I think either Friday night or on Saturday, talking about how they instructed people to get coal supplies at, at
whatever
any
price,
effort. Yeah, whatever. And that's Japan. Japan today, EWJ was down 3%. It's off 9% from its high of 2 or 3 weeks ago. Why? I have no idea why. I mean, I think it had a nice little run finally after doing nothing for 9 months this year. It was absolutely flat going into, August. And then it had a big pop as the prime minister resigned, and talk of a new stimulus package and finally getting COVID under control, et cetera, et cetera. And it had a pop, and then boom, lo and behold, that pop has been erased as people have decided to take what profits they have in the unsettled environment that we've witnessed in the last couple of weeks. But to me, that's an opportunity to step back into something like an EWJ, like Japan, because nothing's changed on the fundamental case that makes Japan attractive. Delta is fading. New government is going to bring a significant fiscal stimulus package to the fore. I've read somewhere up to could be as big as 5% of GDP. So quite a meaningful size package. Japan is a cyclical play on the global economy and on Asian reopening. It itself is reopening. Japan is the only major economy in the world with a composite PMI of under 50 because they've been in such strict lockdown for so long. It's the only economy that's going to grow faster in 2022 than in 2021. Earnings outlook is very robust. Ownership, foreign ownership it's under-owned. Valuation is very compelling relative to the rest of the world. None of that's changed. And if anything, that there's been confirmation. We now have the new leader of the LDP, who's probably going to be the new prime minister when they have the elections at the end of the month. The lockdown has been eased. The stimulus package is coming, and yet it's sold off literally 9% from the high of 2 weeks ago. So that's the opportunity that when I say in unsettled market conditions, investors need to kind of have that strategic outlook. And when they see opportunities like that getting sold off, because people did make money and very quickly, right? It had a big pop, so you can take that profit and go if you're more of a trading mentality. If you're more of a longer term investor like we are at TPW Advisory, you either you highlight that to people as we're doing here in the live session, or you hold, at least in our case, we are overweight Japan, have been overweight, and are holding that overweight. But to me, there are opportunities like that brewing in the markets, and that's something that investors can take advantage of. Climate is the single biggest global macro trend of this decade. Full stop. And therefore, investors need to be understanding it and paying attention to it and investing and positioning in it if they want to be successful as investors over the next decade. And so that's point one. Point two is you brought up the fact that governments are going to work to alleviate the concern of rising energy prices on the populace, which I think makes sense. And that's a very important point, because climate, like COVID, is going to ensure that we have that government plays a bigger role in the economic life of pretty much every economy for the next decade, right? So we are in an era of big government, and you need government to tackle COVID. That's clear. You need government to tackle climate. You and I can't do it ourselves. Individual companies can't do it themselves. It's going to have to be government, public-private partnership to drive this forward. As we've talked about many times, there's an opportunity to make money in the clean energy, in the carbon, in the electric vehicles, in things of this nature, in uranium for nuclear power, which I think is increasingly going to be seen as a way to kind of square the circle. The nuclear plants that were slated for kind of going out of operation are probably going to be extended. There's probably going to be new power plants being created via nuclear power to provide that base load, because part of the problem is that when we have the energy spikes and then wind doesn't blow as much as it has. I mean, part of this issue is that the wind off of the UK has not been as strong as it usually is. I mean, that seems kind of hard. It's almost like when a butterfly flaps its wings, all sorts of things happen, which I've never really been able to wrap my head around. But here, it's actually what's happening. And so it shows you the fragility a little bit of the system, and that's going to have to be dealt with as well. But to me, it's not a surprise. This is the single biggest global trend of the decade, climate and the transition to a low carbon environment. And it's something every investor needs to be paying a lot of attention to. And I think it's going to be one of the key ways to add alpha to portfolios. But again, when you have these kind of price moves and dramatic price spikes, obviously it's very tricky and very dangerous. You can get really chopped up if you buy at the wrong time or sell at the wrong time. All the important things, at least from a Democratic perspective, Democratic Party perspective, that they think are going to be achieved by this human capital plan. My focus has been not so much on the social policy part of the human capital plan, but what it means on the climate side, right? Where there is the big bulk of the climate package for Joe Biden is in the human capital infrastructure plan, particularly around clean electricity standards, as well as around electric vehicle charging system nationwide, and electric vehicle subsidies to drive electric vehicles to become 50% of the fleet or 50% of new car sales by 2030. That is in that infrastructure plan. And therefore, that's what I have been focused on, because those two things, I think, are what gives the U.S. the only chance it has to make the 2030 peak carbon Paris Accord targets. So, and I've spoken, and we've spoken, and I've written about how climate speed telescopes time. So when you think in the U.S. framework that maybe the U.S. has 9 years to meet the peak carbon target, it doesn't. It actually has like a month or two to pass this, which then provides the opportunity to make the target. If this is not passed, then the U.S. capacity to meet the Paris Accords is virtually nil. But strategically, so here looking out 6 to 12 to 24 months, the big strategic thing to keep in mind is that I do believe we're on the cusp of the strategic global expansion that I've been talking about for some 6 to 9 months. I thought it would come in the second half of this year. Delta has obviously delayed that. But now with the Asian reopening, we have Europe, the US, and Asia all reopening together. That is going to drive a synchronized global expansion that lasts through 2022, most likely into and perhaps through 2023, driven by the inventory restocking, right? For all the supply chain stuff, remember, the inventories need to be rebuilt. And so that's very, very good for growth. Strong consumer demand, right? The household net worth we just talked about, record all-time high in the US, very strong wealth gains in Europe as well. So the consumer globally is in very good shape. And then third, a CapEx boom designed to deal with climate in part, designed to address the supply chain issues, designed in part to provide production facilities in each of the main 3 regions, right? Electric vehicle batteries in Europe, semiconductor plants in the United States, et cetera, et cetera. So I'm of the view, and this is why I remain constructive on equities and commodities, nothing that's happened in the last couple of weeks, in my view, has derailed that big, strategic driver of a synchronized global expansion. If anything, in my mind, the data and the outcomes of Asian reopening, et cetera, are bullish and constructive for that strategic synchronized global expansion to take place. But then there are 3 market transitions that I think we're entering into that are important. The first is the shift from liquidity-driven markets to earnings-driven markets. I think this is why the supply chain concerns have gotten people so exercised, kind of as a market story as opposed to just a sector or stock story, because people are worried about margins, because we are shifting from liquidity-driven markets, even though financial conditions still remain very, very easy. But we are shifting to an earnings-driven market. And again, we are coming into the earnings cycle. Again, not so much how important Q3 earnings are going to be, but what's the outlook for Q4? What's the outlook for 2022? The second is the shift within equities from growth-driven markets to cyclical value-driven markets. Obviously, that's critical. We've been in a growth-driven market for a decade. We all know what that means in terms of U.S. versus the rest of the world, tech versus everything else, et cetera, et cetera. But remember that as we talked about some time ago, higher rates are a kryptonite for tech stocks, and we've seen some of that play out, obviously, in the last couple of weeks. I think we're probably early in that. I don't expect tech to implode because they're very profitable. You know, a number of the certainly the bigger companies that make up that famous 25% of the S&P, super profitable companies with tons of cash to buy back stock, to increase dividends, et cetera. So it's not going to be an implosion, I don't think. I think it is more going to weigh on the U.S. relative performance as an anchor and weigh on the performance of growth versus value. So I think that shift is going to take place. As I say, that's a transition I think we're starting to enter into. We had a taste of it last spring, last fall and last spring. I think this shift now is, if I'm right about that strategic synchronized global expansion, the shift from growth to cyclical value is going to be a sustainable shift, sustainable, let's say for a year or two, as opposed to a quarter or two, which is what we had in the fall of last year and the spring of this year. And then third, and most important, the transition from from bull market in bonds to a bear market in bonds. And here, talking primarily about government debt, particularly in the United States, but also I think to a lesser extent in Europe as well. And so here, you know, the 10-year bottomed last spring at 0.5%. It's now 1.5%. According to folks who are technicians, we need to break 2% on the 10-year to convincingly break the 40-year, you know, trend of lower rates that's been in place since Paul Volcker in the 1980s in the United States. But I think we're going to get there. I think we are going to break 2% on the 10-year. Remember, you and I were talking, you know, late last year about my target was 1.8 to 2% for the end of this year. I still think that's a reasonable target. I do think, I don't know whether we'll break 2% on the 10-year before year end, but I do think in the next year, we will break 2% on the 10-year and break that 40-year bond bull market and convert that into a bear market.